Well, good morning, everyone, and welcome to Contact's interim results for the 6 months ended 31 December 2019. Usual disclaimer, we're going to go through the pack in 3 parts. I'll give some highlights, a bit of progress. Dorian will take us through the detail, and then just a little bit of what's the market looking like going forward towards the end, and then Matthew will handle the questions. Not the answering of them, just the administration of them. It's fair to say that, performance relative to the prior period always had a fair chance of being down, given how strong the prior period was. For Contact specifically in the half, obviously the well-worn story of reduced gas supply and reduced reliability of gas supply impacted our earnings with higher gas costs, higher carbon costs, but importantly, from a shareholder perspective, the prudent management of risk, such that we were actually out of the C&I market for the period. Despite all of that, the renewable part of our business performed well, costs performed well, and we still achieved a cash flow which exceeds the declared dividend for the half, which is as per target and as per expected at 16 cents. What has become clear to us through the period is that the future of the Taranaki combined cycle power station is increasingly at risk, and we've taken the decision to bring forward the useful life of that plant, thereby increasing the depreciation charge for the next 3 years or so. Given the unreliability and cost of gas and rising carbon costs, it's pretty clear that there's a great substitution opportunity for us, geothermal for gas, and we've taken the decision to accelerate the depreciation. Now, of course, that's just an accounting change, doesn't mean the decision's made, but it's a pretty strong signal that that plant won't be operating past 2023. The trend's still good on the efficiency focus that we have and the building of the capability that we've been doing for the last 3 or 4 years. The graphs can't always go in the right direction for every measure all of the time, but the trend's your friend, and you can see that customers are increasingly advocating for us, and we had a bit of a dip in the half as we rolled out broadband and the massive growth in that. Pleasing to see that that's now above 30 as we go into the second half. Costs obviously down, some very low severity incidents, employee engagement continuing to rise, and certainty for our shareholders around a dividend, and our target remains at 39 cents a share. We've always taken a holistic view on our business, but increasingly we'll be describing that performance externally, and this is a bit of a taster. Clearly, with one of the first signatories in the region for energy to the Science-Based Targets Initiative, renewable generation and carbon intensity is an important measure for us. As this has been a feature of the last year, the focus on vulnerable customers and how all customers are being able to access the competitive market. We'll show you more information there, and with our new range of products, we've been able to accept an awful lot more credit-impaired customers than we would have done in the past. And in fact, we're seeing more credit-impaired customers come to Contact because of the great products that we offer. And of course, diversity has been top of the agenda at Contact for a long time. A couple of years ago, we were counted by Reuters as #1 in the world. That's really a taster of more to come on a broader ESG set of metrics. To the market over the last wee while, feel like it's been a feature of my tenure to say that demand is flat, but demand was flat again if you strip out the irrigation-related increase on the prior period. Natural gas production is recovering. You can see that 19 on 17 calendar year, and the gas market runs on a calendar year, was down 12 petajoules, pronounced in the halves, but we saw the first half of 20 recover, and we expect that to continue. And as you will have seen today, with a supplementary press release that we have contracted some gas for 2020 through to 2025. It's clear that petrochemical and electricity bear the brunt of any unreliability in natural gas supply, marginal field, marginal plant, and that's why we've had the underperformance in the half. But we do see that continued improvement in gas supply continuing. Technical phrase, it's been as wet as buggery for the last couple of months, but hasn't actually translated in the half into a greater hydro generation proportion for the industry. But we do go into the balance of the calendar year and into winter with masses of storage. I think only for the second time, only since 2013, we've just tipped over 4 terawatt hours of storage in the market. So that bodes well for a well-managed winter, particularly as the gas supply is recovering, but you wouldn't say recovered. Again, in the period, you've seen this chart before, it's important increasingly to look beyond hydrology and look to all of the factors that are affecting the electricity market, including methanol prices, gas prices and availability, carbon costs, and I'll come to it later, but of course, what the aluminium smelter may be thinking. The long-term futures prices are now actually trading much more like the short-run marginal cost of thermal. And on this right-hand chart here, we have a go at what Contact's thermal SRMC was for the first half at $102, and had a little bit of a range for what we believe is probably the higher cost of coal. So we are seeing the market working, that there is a supply-demand tightness, and the futures prices are trending towards thermal short-run marginal costs. And I think that's pretty evident now. On to retail, continues to be intense. A bit of a continued trend of net, the big players staying about flat with some winners, losers, and some flat players. But the tier 2's growing significantly. And if you want to try and do the maths between 13 and 68,000 customers, that's connection growth over 2 years. So you can see that the second tier players, particularly Electric Kiwi and Nova, are continuing to compete and continuing to win customers. But that's partly why the electricity price for consumers is hovering about CPI increase rather than increasing at the rate of the input costs that we've seen over the last couple of years. So our strategy remains unchanged. We are focused on optimizing our business for cash flows, disciplined and transparent approach to the portfolio we hold, and in our customer business, continuing to leverage the brand and technology to deliver an operating model that is best in the sector. We've made reasonable progress on that in the period, with significant improvement in the digital adoption in our business. We've now got robotics working across 14 key processes. Stuff that used to take 2 hours now takes 15 minutes, and we expect that to improve markedly over the coming years. All of that's resulting in a better customer experience, with our share of complaints continuing to reduce, and a continuing trend for us that bad debt write-offs continue to fall. I mean, we must be close to zero now, which is actually pretty impressive. The brand refresh 18 months ago clearly is resonating with customers, not just the awards circuit, and we can see how it's helped us win 20,000 broadband connections and grow that pretty quickly. The wholesale business continues with its decarbonisation push. Simply Energy is, I say integrated, but integrated is the wrong word. Simply Energy has been leveraged well to work with customers, including the contracted 13 megawatt boiler customer we've got, who we can't name, but it's contracted. Our demand management platform is growing at an amazing rate. We're, a couple of months ago as a megawatt, we're now at 7 megawatts. This virtual power station idea is growing at a pace with very high conversion rates with customers. But of course, the big dial mover in that business is Tauhara, and Tauhara has continued apace. You will have noticed we had some rig wobbles, plus the strategic review of the aluminium smelter has made the push for FID today, which is what we may have said 18 months ago, somewhat irrelevant. But what we have seen over the last couple of months is a very hot resource in the first wells we've drilled, and we continue to delineate that, where is it and how big it is. But it's clearly a minimum of 3 square kilometres and 300 degrees, which was our target resource. And the tender process for the power station, which is more than half of the cost of the station, has come in very, very competitive and has exceeded our initial expectations on those prices. So the levelized cost of energy, or the LRMC, that we would have talked about when we hosted you in Wairaki last year, absolutely achievable. And with that, I'll hand over to Dorian to give us the ins and outs.
Thanks, Dennis. So there are 4 key themes that are going to come out when I go through the financial and operational performance. The first is, Dennis has mentioned already, is that we've had relatively low levels of both stored and contracted natural gas impacting our supply risk profile. So we've been countering that by reducing the amount of fixed price volume that we commit to into the future, and also conserving fuel. So it's been great to see that our risk controls have actually been functioning well, because that binds our earnings at risk in a position that we're comfortable with, and that's very important. But when we go through the financials, you will see the ramifications of that good risk management in the numbers. Our retail business has been considering the outcomes and the drivers of the electricity pricing review, and has now started to implement the findings. I mean, we think the way in which we sort of positively engaged with that process has led to what we think is a relatively good outcome for both Contact and for the industry. But you will see the implications of that in our customer business, and in particular around the pricing that we've achieved. The rate of underlying OPEX reduction, you'll notice, has slowed a bit, and that's only natural. A lot of the low-hanging fruit has been picked, if you like. We're still very committed to getting our OPEX down. We think strategically that is the right thing to do. And obviously we're still committed to any guidance that we've given in this area. It's just more of a heads up that you will see more transformational type change required into the future in order to keep that momentum on OPEX reductions. And the last point, Dennis has mentioned, we now think it's unlikely that we're going to continue to use TCC post FY23. We align our accounting behind that assumption, which has led to $9 million of additional depreciation at the half year and $18 million for the full year. So now onto the numbers. Profit after tax of $59 million for the year. Comparison with the prior year is skewed due to the rock gas disposal. You're better off looking at it on a continuing operations basis. In that regard, we're down by $40 million. The biggest variance is around EBITDA, $57 million down. And we've put a neat waterfall in there to sort of make it easy to understand what's going on. So if we just sort of talk through that, we've got a $19 million pricing headwind, and this is around the fact that we were able to get some length and support the market when it was stressed, when we had that unplanned power core outage. There are some negative consequences with that, in that with the high market prices at that time, things like location losses risks were higher, cost of acquiring generation was higher. But when you wrap all of those things together, you've got a $19 million headwind year on year. We've seen lower hydro levels, as Dennis mentioned. We would normally substitute in increased thermal at an additional cost of $10 million for that. However, because of this natural gas constrained environment we're in, we've had to we haven't been able to do that as much as we normally do, and we've had to acquire more generation, and there's a negative spread on that, and also reduce the amount that we actually sell, and therefore you lose the sales margin. Also, the gas producers are charging more for gas because it is a scarcity product at the moment. And we've seen our retail gas margins decline a bit, which is a timing topic. I mean, we probably haven't been as quick as we should have in terms of passing those increased costs through to customers. Market making has gone 7 million the wrong way for us. We made $5 million of profit in the prior corresponding period. We had a $2 million loss in this period. This is a more volatile part of our business. We are having to participate in market making. We don't think it is a true market making environment, and it does force the market makers into positions that they wouldn't necessarily take. Under the EPR outcomes, we're having to commit more volume to market making. So this is a topic and an area that we'll be focusing on quite heavily to make sure we've got the right capability and focus to ensure that we get the right financial outcomes. And in terms of our fixed costs, they're higher by $4 million. And this reflects that we haven't owned AGS for the entire 6 months of this period, whereas we did own it for 3 months of the prior corresponding period. So that explains why the EBITDA's down by $57 million. We've talked about why the depreciation is higher due to TCC. Interest costs are coming in $11 million lower. We have started to capitalise interest associated with Tauhara. Again, there's 3 million associated with that. Underlying interest is down by 8 million, and this reflects the fact we've just got lower levels of average net debt because of the proceeds that we got from those 2 disposals we made last financial year. And the other thing I'm quite happy about is we've got our overall average interest rate down as we've been able to rejig our interest portfolio and get more exposure to variable interest rates, which are lower than our fixed. You've got tax coming in lower, which is the natural hedge for lower profits. So that gives you the overall picture. If we now look at it on a segment by segment basis, you can see that the wholesale business is down by $39 million, and that's a function of an exceptional prior year and this natural gas constrained environment that we're in this year. The customer business is down $18 million, and this reflects the fact that we have been focusing on the electricity pricing review and are implementing the findings associated with that. So that has meant that we have been buffering customers from the higher energy costs and higher network costs. We will be looking at what happens with the wider market, but obviously with a view to recover cost increases over time. I should just add on this point is when we look at price changes, there are lots of different considerations, but one of the key learnings from the electricity pricing review is we always look at it from a deprivation index now when we make those type of decisions. And the last segment there, corporate, you can see that's flat year on year, so the costs are under control in that area. So now we go on to the wholesale business and do our usual sort of deep dive here. So costs are up by $7 million due to higher thermal costs, and I'll talk about that in a minute. Acquired generation volumes are up year on year, reflecting we've got lower own generation that we've been trying to offset and some risk management positions we've been taking. But you'll see that the cost of that acquired generation hasn't gone up, and that reflects that acquired generation has been cheaper year on year. Dennis mentioned that hydro volumes have been lower year on year. So obviously there's been a lot of talk about how wet it was, but that was only a small period at the end of the half year period. The first 4 months were relatively dry, and you're also comparing it to a relatively wet prior corresponding period. Geothermal volumes are flat. That's why we like that type of generation, flat, consistent as expected. And thermal volumes are down by 12, but we were doing some tolling gigs, down by 12 gigs. We were doing some tolling for Nova, tolling their gas and selling it back to them as a CFD. If you actually look at it excluding that, considering sort of our gas position, our thermal volumes were down by 171 gigs, which I think better reflects the sort of natural gas constrained environment and the fact that we've been conserving fuel. So over that period, we got our stored gas in AGS up from 4.5 PJs to 5 PJs. And I'd also add actually one of the beauties of having AGS is the flexibility it actually gives us in the marketplace, which I think is pretty unique. So when you have things like Waitara Valley go down and there's surplus gas, we are the player that can take large quantities of gas at short notice, which we have been doing. And as we sit here today, we've got close to 6 PJs stored, which is obviously good from a risk management perspective. Just quickly on our thermal assets, we talked about this at the full year and how our peaker availability hadn't been where we wanted it to be. That was linked to the fact that we'd found some issues, extensive corrosion with the rotors on the 2 peakers, and have been going through a 1.5 year refurbishment program. That finished in September 2019, and we now have no planned maintenance on those peakers. And we've also got TCC fully rated and fully available. So whilst we're in this relatively uncertain period because of the HVDC constraint, it's good to know that we've got both those assets available on the North Island for us. And indeed, we are using them. So just on these thermal costs that are coming in higher, if you look at the numbers going through our accounts, our cost of gas has gone up from $6 to $6.74 per gigajoule. For everyone, the surrender rate on carbon has gone from 83% to 100%, and the cost of carbon has gone from $20 to $22 per tonne. If you translate that into a thermal cost of fuel for us, we've gone from $65 to $71 per megawatt. But that actually doesn't tell you the full picture because that's all based on the historic cost of when we bought our carbon and when we bought our gas. If you're looking at it from a current market perspective, you probably pay $8 a gigajoule for gas and $28 I think carbon's trading at the moment. So if you start putting those through, you get to a short run marginal cost of thermal, which is well in excess of $100, which is what Dennis showed you earlier. And actually that's one of the things that sort of played into the decision around TCC. It's the question, well, can you actually make money with baseload thermal generation anymore based on wholesale prices, where they're going, and the cost of gas? So now on to our contracted revenue for the wholesale business. It's down by $10 million. However, there is a transfer price increase from wholesale to customer, which is plus $13 million included within there. If you adjust for that out and just look at it on a third-party perspective, we're down by $23 million. And that reflects the fact that we've had lower volumes. Volumes are down by $10 million. Do you remember I said earlier that as a result of the natural gas constrained environment and the lower hydro, we are having to reduce the amount we sell? This is where you can see the negative coming through here. We've actually got lower pricing of $7 million as well, because we were able to get away some short-term CFDs into those high prices in October and November 2018, and those haven't repeated. And we're also, remember, supplying more to the smelter because of the fourth pot line. There's an extra 60 gigs going to the smelter year on year from us, which has an opportunity cost. So that's why pricing's down. And then you've got $6 million of other income being negative, which reflects the market making that we've talked about. So just to preempt a question, which I'm sure may well come up, why is our netback flat on C&I when everyone else is in the marketplace based on operating stats seems to be going up? Now, there's a good reason for this. I'm just going to repeat what I said earlier on. With natural gas availability issues, we've got less stored and contracted natural gas. So our supply position from a risk profile has changed. We need to adjust to that, and we adjust for that by making sure we have less volume, fixed price volume committed into the future. And our mechanism for doing that is reducing our C&I book, so that when contracts come up for tender, we don't recontract for them. And that gets our volumes down and balances the risks. So actually the fact that our netbacks on C&I are flat, I'm very happy with, because that actually shows that we've got good risk management in place. We could have pushed up our EBITDA probably by recontracting more C&I, but that would have blown out our risk profiles, and that's not what we're about. On our wholesale trading and merchant revenue, this is relatively simple. We're down by 22 million, but you can see there in the middle that the price that we were getting on our length last year was $170, and that's dropped to $108 this year. And that reflects the fact that we got length in October and 18 and November when the market was stressed into those higher prices, which obviously hasn't repeated. So that's the wholesale business. If we now look at the customer business, I've put an extra table in here for you, which I think will better explain our electricity revenue. What I've done here is I've isolated the accounting impacts so that you can actually see the business on a cash flow perspective. So what I call net revenue cash. This is how I look at the business, because what I want to be able to see is if our electricity gross revenue is going up because we're getting tariff increases at that level, I want to be able to check that we're not then giving that value away through paying higher incentives to customers to acquire them. So I want to be able to see those two things to check that we're being kept in balance. Also, you'll know that we've announced that for new contracts, we have stopped doing prompt payment discount plans. So the value of our prompt payment discount not taken will start to reduce, and therefore it's important that you can actually see that in our financial performance. So whilst this might seem like a bit of extra detail, I actually think with the complexities of retailing electricity in New Zealand, I actually think you need to be able to understand this level of detail to be able to understand performance. So creating a bit of a rod for my own back here by being very, very transparent, but we're comfortable with that because we're comfortable we can perform. And to be honest, actually capital markets really understanding what's going on with our performance is good because it provides that extra layer of tension for our performance. So on that point, you can see that EBITDA is down by $18 million. There's two key things feeding into this. We've had relatively flat pricing, and obviously we've got those higher energy and network costs flowing through. So on the relatively flat pricing, as I said, we have been understanding and now implementing the findings from the electricity pricing review. What that's meant is we've had relatively little flow through from FY19 price increases. We've been shifting customers onto plans which better suit them. So a good example of that is 16,000 low users going onto the low user plan. So whilst that has an adverse impact on our short-term pricing, it obviously helps with customer engagement, and it also helps with reducing customer churn, which is a good thing in the longer term. You can also see on the slide the impact of the PPD not taken. So that's come down a bit, reflecting that we've now got 60,000 customers on non-PPD plans. So that's why we're seeing flat pricing. Now, when I step back from this and take a sort of bigger picture view of it, our PPD not taken on an annualized basis is about $12 million. Based on customer churn and wins and losses, we'd expect that to unwind over about 3 years, which is a $4 million headwind every year for the next 3 years. When you also consider what's happened to network costs and energy costs over the last 24 months, there is a need to get more price effect through. We actually think it's very reasonable to be targeting a CPI type increase on our electricity gross revenue. And if we are achieving that, that will more than offset the headwind in terms of the unwinding of the PPD. We also think that's good because it continues to buffer our customers from the volatility in the wholesale markets. And we think that's appropriate because we see this as more of a long-term strategic channel rather than a commodity one. So then when you consider the higher energy costs and network costs that we've seen coming through here, then actually this becomes a timing issue because, as you saw the earlier on in one of the slides, the wholesale price into the future is predicted to plateau now at about $100, reflecting more gas availability and those wind projects coming online. And if you're getting CPI increases on your tariffs, then you're going to see a convergence there between the costs and the pricing. Onto our OPEX or our other operating cost movements. So good to see it's continued to come down there from 110 to 102. We've continued to be transparent about how we report this. So you can see the cost reductions that we naturally get through the fact that we've disposed of businesses and the fact that we've accrued less for bonuses because the profit performance has been lower year on year. We've continued to explicitly show that on cost associated with the rollout of broadband. And we do that because those costs should disappear into the future as we better embed that product in with our business processes. And then that gives you what we call our underlying movement. So you've got a bit of inflation, $1 million of inflation, and then you've got $2 million of underlying cost savings, which is lower than we've been seeing historically. And hence my point earlier that whilst we're okay for all of the guidance that we've given to the capital markets, to keep the momentum going down, we will need more transformational changes into the future. Right, this next slide is a new one. It's actually a very important slide. Based on our asset portfolio and how we operate, we've communicated that our expected and normalised EBITDA is $480 million, and our operating free cash flow associated with this is $280 million, and we pay out 100% of that as a dividend, which is 39 cents. So the most important piece of information that we can actually share with you is how are we actually performing against that expected and normalised EBITDA. So on the left-hand side, these are the assumptions that drive our expected and normalised profit EBITDA. These are the half-year versions. So the half-year version of the $480 million EBITDA we talk about is $246 million. And there you can see the reconciliation down to our actual performance of $221 million. I think you'll find this useful for your models. We've also got in the backup the full set of assumptions for the full 480 million for the full year. I guess the other comment here is to reconfirm that structurally we still think $480 million is expected and normalised, and we do. So whilst things like thermal costs are coming in higher than we expected them to do, we would expect our channels to reprice to offset that over the medium term to leave us whole. In terms of our cash flow, operating free cash flow at 220 million is down 83 million on the prior year, but that reflects the fact that we don't have rock gas in our numbers this year and the underlying EBITDA is lower. And also that the tax paid was higher because we pay the final tax payment for FY19 in this period of FY20, and that was particularly high because of that high profit performance. We look at our ability to convert EBITDA into operating free cash flow, so our cash conversion. We've got, I think, one of the best conversions in the industry, if not the best. We've dropped from 70% to 54% on that, but that reflects that tax payment for FY19. So we're still performing very, very well in this regard. And one thing I'm particularly happy about, when you look at our trade working capital there, $5 million reduction, that's even though we've been net injecting into AGS. And that represents the fact that we focus a lot on cash generation as a business. And if you look at on our balance sheet, the contract asset number, which feeds into that, which I keep a close eye on, has actually reduced. So this is the amount that we are having to give away to customers in order to convince them to buy our plans. Now, it's early days, but one of the things you could read into that is that customers now are buying our products more for the value of our brand, for our service, and for the fundamentals of the products, and less for the sort of free giveaways that you get when you join. So it is early days on that, but we'll be keeping an eye on that. On our balance sheet now, there are three things I wanted to highlight here. As I said earlier, our effective interest rate has dropped from 5.75% to 5.29%, which is good. And that is about the fact that we've managed to get 20% of our interest book exposed to variable rates. You know, the BKBM is about 1.25%. Our fixed swap rate on the rest of the interest is about 4%. So you can see the more we can transition over to variable, the lower our rate will be. We've got some refinancing we need to take care of over the next 12 months. We've got a wholesale bond of 50 million and a USPP of 70 million. We've got undrawn bank facilities that will cover that, so there's no issue there. What we will probably do, though, is we'll probably wrap that all up with the financing for Tauhara. We do want to be in a position where we've got financing in place for final investment decision. And on that, when you look at our net debt to EBITDA, so our S&P measure on a normalised basis and snapshot basis, it's 2.3. We want to remain BBB, so you have a sort of 2.8 ceiling on that, although as you can see, we have gone above that, and S&P are comfortable you're going above that for a build phase as long as you've got a trajectory back down into that BBB area. And of course we would do, because you'd have an EBITDA stream coming online associated with that. So we're still comfortable that we've got capacity on our balance sheet to fund Tauhara. So the last slide is on the dividend. So hopefully this won't be a surprise to anyone. So we still believe, as I've said a couple of times now, that our expected normalised EBITDA is $480 million, and that the associated operating free cash flow of $280 million is still sound, and that we pay out 100% of that, which is 39 cents. We normally split our dividend interim final 40-60, which gives you 16 cents for the interim, which is what we're declaring. And that's 10 cents imputed based on our tax position. So hopefully that wasn't a surprise to anyone. Hopefully this is the second year in a row of this dividend policy. So hopefully the repeat of it adds even more to the clarity that investors get around this type of policy. It's our balance sheet capacity that actually allows us to buffer investors from hydrology and give this level of clarity around our dividends. And if you're interested, you know, that gives a 5.4% dividend yield, which isn't bad. So with that, I'll hand back to Dennis.
Thanks, Dorian. I'm not going to talk about much here. There's only a few big topics. Obviously, the first one being the smelter. Our view remains that the first step in decarbonising a country is not to send low carbon production offshore to a higher carbon world. So we think that the smelter fundamentally it is a good thing for New Zealand. And any disorderly exit impacts many, many stakeholders and all of the gentailers. So with that in mind, we're actively engaged in trying to keep the smelter through our electricity supply. Obviously, Meridian take the lead on that as the counterparty, but you can rest assured that we're close behind them and supporting them at a level which we think is reasonable and a level which we think is manageable in our earnings outlook to maintain our assumptions on earnings and dividends. Having said that, as the smelter review is a more real step than just a bit of noise, work on the mitigations continues. And, you know, as it's more real, the mitigations get more real. So, you know, a few years ago when the smelter was under review, but everyone had an expectation that it would quickly stay, the Lower South Island upgrade project was referred to as being 3 summers and a lot more money than we're seeing today. So this is an example that the creativity that the industry can bring to bear, in my view, will mean that that Lower South Island upgrade could complete as early as mid-2021. You know, the reality of an exit makes the mitigants more real as well, and you'll see a creativity in the industry. And it's certainly not as bad as the market cap loss across the industry. We've shown through contracting our own dairy conversion that the electrification is real. It's real at prices way north of the smelter price, but as you would expect, south of the ASX price. And there's much commentary about the impact on Contact of the closure of the smelter on its thermal kit. You can see today with the accelerated depreciation of TCC. Smelter aside, we don't expect that plant to be making any money, so we struggle to see how it can be an impact. But summary is we're actively engaged. Obviously, it's in their hands, and there should be news over the coming weeks and months. If that doesn't work, then the mitigations are stronger and more real, and the response, I think, will positively surprise everybody. Just because it's topical, there's a couple of regulatory matters I wanted to comment on. First, the undesirable trading situation claim and the market making that did impact us in the half. The undesirable trading situation, you know, it's easy to throw stones when you're looking at a large, complex industry which is responsible for an essential service. So although it's quite media worthy to see pictures of second-tier retailers with our spill gates open, the Clutha received more than twice the water it was able to process through the turbines. So unless we want to spend billions of dollars on new dams and transmission lines for you know, infrequent high inflow sequences, then it's clearly a ridiculous claim. What it does lead me to, though, is a call for a more monitoring approach by the regulator rather than a big noise investigation. Does no one any good to see the industry played out in the press. So I think a monitoring approach by the regulator would certainly support a smoother operation of the industry. Somewhat related is market making. Market making volumes have risen over time. As you can see in an earlier chart, the growth of the second tiers doesn't appear to be being constrained by market making. And in fact, market making has a number of non-retail speculators participating, including speculators that own second-tier retailers. So we don't think the tightening of the market-making arrangements are to the benefit of consumers. We think it adds cost to the industry, and ultimately that will be borne by consumers. As I've mentioned, this is not, you know, a simple industry, it's an essential service, and having a prudent approach to retail is what is more appropriate in my view. You can see in the UK disruption caused to customers of retailers coming in and out of the market, and it does no one any good. A bit more specifically to Contact and the announcement we made today that given the improving gas supply outlook, we have contracted gas. Bit of a 101 on why we need gas, and it's essentially because we do have variation in our hydro production, and on average we do need 8 petajoules, but can, if it's drier, need more. So we have announced 3 transactions today. One is a new swap arrangement for this year, notification of our pre-committed contract with Maui for next year, and a new purchase from OMV for 2021 through to 2025. So with the masses of water in the system, plus the gas in storage, we feel very comfortable that the short-term gas supply for Contact, short to medium term, is resolved. That's come at a higher price. We showed what that meant for first half results in the earlier slides, but we are now seeing the short-run marginal cost of our plant go into the 90s. That's on the average gas price. If you were to take the highest cost gas in our portfolio, it would be even higher. Dorian's mentioned that through the period we were impacted by our risk management, and the reason why we are prudent is clearly because of the dividend certainty that we provide, which we think shareholders like. And the chart on the left, albeit without too many numbers on it, shows what would have been possible if we'd have taken a riskier position in terms of EBITDAF. But you can see along the bottoms our earnings at risk increases materially. And we look at this all of the time with the board, and we think we've reached a reasonable balance where our risk settings are such that we can continue to give that dividend certainty through multiple scenarios. The easiest thing to do, of course, where your risk is driven by supply and demand, is if the supply isn't there, is to drop the demand, and that's what we did in the period. But we are now, with the new gas contracts, significant storage and some other contracts, looking to re-enter the C&I market, and that will obviously drive improved earnings. And then just finally on the right-hand chart is if we have an average year in 2020, are we okay? The answer is yes, and if it were dry, still yes, because there's a lot of stored water and stored gas around. Priority areas near term, in my language, might be the next 3 weeks, but for the organisation probably goes a little bit longer. As I've mentioned, constructive engagement with the Meridian and the Smelter. Get back into the groove, given we've now seen a more confident gas supply outlook. Continue to drive costs and get those input costs more appropriately passed through to our customer base. It was announced recently that the transition is occurring. Mike starts on the 24th, I finish on the 28th. We're in open plan in this office, so it's unlikely Mike and I will be sitting at the same desk, sharing a desk. But as I committed to the board and the market, there would be a smooth transition with no gaps. And of course, as the Smelter, you can top and tail this section and say, as the Smelter resolves one way or another, then we expect Tauhara to resolve one way or another. And then longer term, same story, continuing to lower the cost and capture scale efficiencies in both of our business. And, we've seen in this half, with Simpler, with the governmental and societal push on decarbonisation, a real acceleration of the interest of customers in decarbonisation opportunities, which will result in demand growth. What does that mean for our confidence in the cash flow of the business and our ability to continue to support the dividend? Continued confidence that with gas in place and the continued efficiency program, the EBITDA and therefore the cash flow is under control. We've not changed any of the cash items versus guidance at the full year. Of course, depreciation will go up, interest will go down for the reasons Dorian explained. So we fully expect to be able to cover the FY20 dividend target of 39 cents per share. And with that, we'll go to questions. Matthew.
Thanks, Dennis. This is the question and answer section of the presentation. For those attendees that would like to ask a question, I'll ask you to use the raise hand functionality that's provided through the app and through Zoom, and we will promote you to be a panelist.
Can I raise my hand?
Yes, well, maybe we'll start in the room with Andrew.
No technology limits there.
A couple of topics I just wanted to sort of cover off. One is, first of all, the 480 and when you think you might get back to that, because obviously you're not in the C&I market right now. So one assumes the second half earnings for this year, and I guess even the first half earnings next year, are going to be hampered a wee bit as you get back into the C&I market. Is that a fair and reasonable assumption? I guess is the first question.
Yes.
Yes.
Yeah.
And secondly, with the HVDC constraints we're seeing in the market right now, I guess you've got a lot of water, but you can't get it north, and the pricing's being impacted. So net is that, I guess, being a positive or a bit of a headwind for you at the moment?
I mean, January, ops stats back end of the week, but first flush of them looked like similar to last year. Obviously, February's got a little bit more price separation. But with our North Island plant available and the way the reserves market works, it's, you wouldn't say it was a tailwind, but it doesn't look like a headwind at the moment. One of the things that's become clear through this period is that the modelling one has to do when there's a significant event like the HVDC not working. There's a whole heap of complexity, which I think is actually instructive for the smelter. So if the smelter were to close, how one manages the location factors, the reserves market, security of supply, there's a degree of complexity that tells me it wouldn't be as bad as we might have first thought. And this period is actually quite instructive for that. But, net at the moment, we're sort of similar to prior periods.
Okay. And the second question I had was just around Tauhara and thinking about the sizing of that. I think in the past you talked around about 130 megawatts or thereabouts. I just guess I'm thinking your commentary around TCC and its profitability, I suspect also applies to Unit 5 at Genesis, and sort of are you having negotiations, discussions around that, which might see us above 130 megawatts?
We've said before that we're actively happy to sell elements of Tauhara to long-term PPA arrangements with either gentailers or other industry participants. So the answer is yes. The primary focus at the moment, though, is delineating the resource. If you could sell more, you might not sell more in the first phase anyway, because it's a resource that we'll learn more about it as we go. I joke that Wairaki took 57 years to reach its full potential with Tamihi. So I don't think you'll see us go above 140 initially, just because you do need to really understand the resource. It may be that more of that 140 goes to third parties and not Contact, but yeah, it's an ongoing discussion.
Thanks for that, and all the best for the future, Dennis, and personally enjoyed our interactions in the past, although I'm not sure if it's reciprocated, but anyway.
It's been fun the last 9 years. I didn't make the joke, but I think just over 9 years ago, David and Liz also produced an earnings at risk chart. Some of you may remember that far back. But they actually had numbers on it. And I've seriously underachieved versus those numbers. So I didn't want to leave Mike with an earnings at risk chart that did the same thing for him. Thank you, Andrew.
Okay, thank you. We'll go to the lines first. Stephen Hudson, we'll promote Stephen to Questions? Hi, Stephen.
Hi, guys. Look, just a quick question on Tahara. You've talked about a dollar cost per megawatt across, the full sort of 250 megawatts. I just wondered if you can sort of chunk it down in terms of the phases and what the costing may be, and also given I suppose a favourable repricing or repricing of the NZAS contracts. When you would expect first production on the first phase. So if you can just sort of talk us through production and costs on a phasing basis, that would be useful.
I mean, I think we've said the 250 megawatts works out at about 4 million a megawatt. If we were to do a half that first up, or 140 megawatts, it'd be lower than the average, maybe more like 3.6 million a megawatt. Obviously, that's not all the story, because ongoing operational costs make up a good few dollars a megawatt hour. I'm just trying to. So the first half's cheaper. And in terms of timing, assuming the smelter passes, then the TCC end of life is instructive. We would expect to be overlapping slightly. So TCC closes in year 23 towards the back end, depending on hydrology, and Tauhara starts to commission earlier. I mean, there's a technology choice on Tauhara, which I won't go into too much detail because we're actively negotiating with tenderers. But if we were to go big flash plant, then single units, but we have smaller units and still achieve those long-run marginal costs. So you might get some early unit commissioning in early 22, late 21.
And Dennis, just a quick follow-up. Would the EPC contract be sort of full, you're fully off risk, or would you contemplate sort of some variation on the EPC contract where you perhaps bore some of the construction risk?
I mean, obviously, we will take the risk on the steam field because that's our equipment. We deliver steam to a power station inlet, but past that inlet, it's all the contract with liquidated damages provisions if they don't deliver. So we're not taking any. You can't say not taking any risk. As you saw with Tamihi, where we about $55 million through the contractual arrangements, we would be looking to replicate something of that nature.
That's great. Thanks, Dennis, and best of luck with the journey from here. Thank you.
Thanks, Steve. See you later in the week.
Thanks. Next, we will go to Grant Swanepoel from Craig's Mission Partners. Grant, are you there?
Yeah, can you hear me?
Yes, we can.
Fantastic. Good morning. So now that you've got gas, can I see the C&I book expanding another 500 gigawatt hours, or is that too aggressive?
Over time, Grant, it obviously, because we've got gas and we're available, it doesn't mean that the other side of the equation's there. But over time, over the next 18 months, yes.
Thanks. And then looking at your gas book, I know you gave a whole little metrics there at 674 a gigajoule at the moment. The calendar year 21 looks like your average is about $7.20 a PJ, which means you've probably contracted near $8. Is that what your new contract price is roundabout?
Obviously, they're confidential, but if you average just over 6 and around about 8, you get low 7s, so you're picking it about right.
Perfect, thank you. And if TY does actually have a surprise 1-year closure announcement come April this year, do you have the ability to exit some of those gas contracts you've now committed to?
Well, we've obviously got the space in gas storage and the retail business, and you still have hydrology risk, so the gas needs are still reasonably material. So we don't, but we've bought, this is the trade-off. We could have bought more, we chose not to, and we'll use gas storage to manage that risk.
We have a little bit of flex in the outer years of them, and that sort of actually helps with the uncertainty around TCC and what we do with that. So yeah, there is a bit of flex, but not huge.
And the RMV one drops in 24 and 25 as well, doesn't it? Yeah. Well, we're quite comfortable with the combination of our hydrology risk needs and retail that it's.
And then we've got gas storage.
Yeah, entirely manageable.
Yeah.
Thanks. And then with Mike starting on the 24th and you transitioning out end of the month, the TY scenario, do we expect some sort of decision by the end of this month based on that timing, or do you think this is going to drag out indefinitely?
I think given Rio are a $100 billion company headquartered in London, they're not running their timing based on my exit. Although I'd like to think I was that important. The honest answer, Grant, is that the offer for electricity that's been made has a shorter expiry than the end of March. But you would have to say that if the smelter were looking to go through to the end of March for the decision, then they're going to drive that timing. I'm not, I would love to be planning an announcement in the back end of the month, but I doubt that will occur. To give you some comfort, the chairman, Dorian, all over it in the detail. So there's very little transition risk with me moving on. But as I've said, we're one step behind. Meridian will remain the counterparty.
Yeah. I mean, as we said before, there's a lot of reasons why Rio would want to wrap things up, as quick as they can, because they've got the uncertainty for employees and things like that down there as well. But as Dennis said, unfortunately, it doesn't have that level of impact internationally.
I mean, I think
Thanks.
It's been useful in our industry. It's been useful to have my departure sooner than the smelter. So from our perspective, it's not run to the wire. We are actively engaged.
Sorry, Dennis, final question on that. So can I interpret that actually there's an alignment of your thinking with the board and with Dorian? So Mike, being a man of action, can come in and get his head around all the issues, with the board and Dorian potentially leading the charge on Tauhara's mix with a TY stay or go decision.
Yes.
Yeah, absolutely.
Absolutely.
Yeah.
Yep.
And you know.
Thanks
Rob,
very much.
Some of you will have known Rob a long time. Rob's pretty actively engaged.
Yeah.
With Dorian.
Thanks very much. Thanks for the answers.
Thanks, see you later in the week.
See ya.
Next on the line, we'll have Aaron Ibbotson from UBS. Aaron, are you there?
Yeah, let's try this out. Can you guys hear me?
Yeah.
Yeah.
Fantastic. So a couple of questions already asked, but first of all, best wishes to you, Dennis, and in your future adventures. My first question is, how much sort of more electricity do you think could move to the North Island after the Cluta Upper Waitaki Lines project is completed? And I appreciate it's not an exact science, but at least my experience is I'm hearing quite different messages from the North and South Island dominated gentailers. So it would be lovely to hear your thoughts on that.
I mean, so on the, we think the project relieves mean year constraints, and obviously there's a lot of averages and averages in a mean year that can be dry and wet, but we think it moves 1 to 1.2 terawatt hours. And then whether it hits a bottleneck further north is another question, but the CUWLP can move 1.2 terawatt hours more than moves today.
Okay, that's very clear. And second question, just on TCC, where you've introduced some not super surprising clarity on your thinking. I was wondering if you could update us, just what is the operating cash cost, if I put it that way, of TCC today, ignoring any fuel or carbon costs? I.e., should we expect a certain number to sort of come out of the OpEx if you close it?
Yeah, including gas transmission, which is the nuance in the answer.
I heard that whisper, by the way, so don't pretend that you knew that.
It's, I was going to say 15, but Matt's saying it's closer to 20. Yeah.
And what about, there must be some people working there, it must be a bit more.
Yeah, that's included.
Yeah.
So gas transmission and OpEx, and because it's a big, efficient plant, there's quite a bit of consumables, chemicals and the like. So yeah, all of that is close to 20.
Okay, and final question on my favorite topic of dividends. So if I run your sort of 480 normalized EBITDA less at least what you guide for this year when it comes to capex, interest, cash taxes, and cash interest, I get to just shy of sort of 300 million, call it a normalized cash flow year, which translates, on my estimate, to around 41 cents. So can I invite you to suggest or confirm nay or yay that your base expectation would be for dividends to remain largely flat until Tauhara or something else unexpected or future happens?
Yeah. So 39 cents until there's a systemic change.
Yeah.
We're not sure TCC's systemic enough on its own, but if it were, then that would cause us to increase the dividend. But Tauhara is the trigger for increased dividends. I read your Smelter report, and I thought you were a little shy, saying we go to 41 on Tauhara, where Tauhara's much more cash generative than that, and given its contribution to EBITDA, the capacity goes up. So, if you're looking for a longer term view, it's, I think we've said Tauhara would deliver 6 or 7 cents first phase, this half size phase, and we would look to return most of that because the capacity goes up to fund Waireke with Tauhara. But, that's post Smelter, post FID, 3 years away, but flat till then is a good assumption.
Thank you very much. That's very clear.
Thanks, Aaron.
We'll go on the line to Adrian Atkins from Morningstar. Do you have any questions, Adrian?
No, thanks. All my questions have been answered.
Okay, great. In the room, we'll go to Neville from Jarden.
Thank you. Okay, so a few questions from me. First one, you've talked about CPI increases and sort of kind of given us guidance basically for the next 3 years as you bridge over to what presumably will be a greater renewable penetration in the market and lower prices than the forward curve has today. Do you think your competitors will do that as well?
It's difficult to tell. I mean, obviously, when we're making decisions, we're always very mindful about what's going on with the overall market, and we feed that into our decision process. But as Dennis showed, on a slide, if you look back historically, retail prices have been going up by about CPI. So if history is a good trend, then maybe.
Great, thank you. And the deals sort of on offer to Tiwai at the moment, obviously you can't tell us, I presume you can't tell us exactly what those are, but the market expectation will be maybe 57 million, 50 to 70 million per annum has been sort of the range talked about in the past. The deals you've got on the table, are they going to surprise us compared to that expectation?
I don't know, because I don't know what Meridian have put to the smelter. I mean, I know our contribution goes up, both in volume and price. We think entirely manageable, and Dorian's code around transformation is related to that. I wouldn't be surprised, I guess, if that order between us, Meridian, and Transpower struck the government.
Great.
But I just don't know,
Yeah.
Asking the same question, Neville, in a slightly different way.
Which, you know, is $200 a tonne, aluminium, and that convenient description of their position in the smelter world forgets to mention that that curve is incredibly flat and that the Canadian smelters are owned, so there's no return on capital assumed in the electricity price. You know, so, you know, I think it's material, and I'm not, you know, there's lots of people writing about carbon-free aluminium and the reduction in alumina costs and blah, blah, blah. But I think the industry has stepped up.
Great, thank you. Third question, what's your view on long-run gas price? So obviously seeing a lot of compression now, a lot of tightness, high prices. It's good some of this stuff at higher cost, but is that indicative of where, you know, where do you think it sits in 3 or 4 years' time?
I mean, you've got to start with methanol, really, because although methanol's a little bit lower at the moment, you know, $4 to $5 equivalent a gigajoule, it has sat higher equivalent. And if gas prices sit at, let's use Grant's number of $8, then, you know, the returns Methanex are making, you know, reduce significantly relative to their international options. So it's going to be a bit of a sawtooth, I believe. You know, so I don't think they can sit much higher because then Methanex doesn't work and that gas comes to market, and because the gas is an associated product, the producers will still produce the liquids and gas prices will fall. So I struggle to see it going higher. And then I think there's another phase in a decade where, you know, the gas really is, unless there's a new discovery, the gas is really at the end of life. The gas for our sector is so small that you're beginning to think about import or onshore only supply. And then because it's only 3 to 5% of supply, of electricity supply, the price is somewhat irrelevant. It becomes a reserve cost, you know. Barring anything crazy, I think you've seen a new benchmark in the 7s, possibly 8. As this investment plans out on the existing fields over the next year or two, I think the 8 will be the high watermark.
That's great, thank you. And the last one, just you talked about having up to 6 PJs, we're at 6 PJs now at Ahuroa. The higher extraction rate, you know, you're comfortable with the 65 TJs a day?
Yeah.
Sort of achievable when it's done?
Yeah.
Okay, and
which won't all be ours now, of course.
True. Yep. You get 45 of it.
Yeah.
And the all of that 6 PJs fully available. So that's, you know, that is, make sure my understanding is correct. That is fully stored. That's not including cushion.
Yeah, there's cushion in addition to that.
Yeah.
You'll see a note in the accounts for full transparency that every year you do an assessment of what's working volume and what's cushion volume. And every year we would have a argy-bargy with Origin or ourselves. And you'll see there's a note in the accounts that we're having an argy-bargy with the new owner. My experience is it always resolves itself, and the reported volume is the volume. It's just under a contract now rather than for full transparency.
Brilliant. Thank you.
Can I ask one quick follow-up question?
Yeah.
Just to clarify, the 480, if the Smelter deal comes through, I'm assuming your 480 will drop a wee bit based on however much you support Smelter by?
No.
No?
There's it comes in over time and we'll adjust the rest of the business.
Transformational change type of stuff.
Okay.
So we're not fully contributing day one. Sounds like it's it. I'll see all of the New Zealand contingent over the next week. I probably won't see the Australians again unless I appear in another business. But thank you for your time and see you all soon.
Yeah.